All right, so Schwab signs inflation surge is transitory. So let's read. I haven't read this, so let's read. It's from Schwab. This is my belief. We'll see if Schwab solidifies my belief or makes me challenge it. And I'm going to share with you another article after this in just a second, which does kind of challenge my. We'll see. We'll see how, especially your own investing in value stocks in particular, because that's what I have. The bulk of my portfolio is in large cap domestic value stocks. And my man Harry actually posted, he goes, investing in zombie companies is bad. And I'm going to kind of go with what he was saying to kind of to think on that. We're going to think on this together. All right, so here's Schwab, Jeffrey Kleintop of Schwab, 525.21. Whoa, what's today? Oh, man, I missed it. All right, so anyway. While it's very early to say the rise in inflation has passed, there are signs that the fast part of the rebound in inflation might soon be over. Raw material prices have pulled back from the highs, and supply chains for intermediate goods like semiconductors may be starting to improve. If these early signs continue to signal a deceleration of the upsurge in pricing pressures, market worries over inflation should begin to lessen. All right. Global prices have been inflating at a rapid pace, lifting inflation-sensitive sectors of the stock market, energy, the world's best-performing sector so far in 2021, and driving bond yields higher around the world. The German 15-year bond yield rose above zero for the first time in 2 years. 15-year rose above zero. Google searches for news on inflation have soared, and the chart below the upward trending line indicates inflation. Yeah, look at that. It's nuts. While it's very early to say the rise in inflation has passed, there are signs that the fastest part of the rebound of inflation might soon be over. Since markets tend to react to change in the change, a coming shift to the slower pace of increasing prices could be important for inflation-sensitive investments. A key reason for the shortage of raw materials contributing to the recent surge in prices is supply chain bottlenecks. Port traffic has been congested, impacting delivery times, which are the most delayed in decades. But as the virus restrictions are loosened and output can begin to rebound, the climb and transport costs may ease. Presently, cost to ship intermediate and finished goods by container ship continues to rise. Container ships in the 40-foot box containers they haul are in short because of long delays to unload cargo. I mean, you got to have people to do it, and people can't do it because of union strikes or if they can't do it because of COVID shutdowns. According to the world's largest container ship operator, AP Moller, routes like Shanghai to Los Angeles that normally take 14 days are taking 33 days, twice as long as the average. That's crazy. However, port congestion is showing signs of easing. In the ports in Los Angeles and Long Beach, the busiest container ship ports in the U.S. are currently the most congested in the world. There are now 20 vessels at anchor waiting to be unloaded. That is a significant improvement from the 30 of a month ago and around 40 of the first quarter this year. That means more container ships and their containers may soon be freed up rather than waiting at anchor. Yeah, totally, man. The Baltic Dry Index is a benchmark for the price of moving raw materials by sea over more than 20 different shipping routes. The index has risen from 500 during the depths of the pandemic to 3,250 in early May, but those prices have dipped back below 2,800 in recent days and could mark the start of a fade in the upward momentum. And another sign of cost pressures may soon begin to level off. The percentage of on-time arrivals at ports has been improving. Improved delivery times results in some products that have been in short supply are finally arriving after the long journey. The U.S. industrial production report in April showed that manufacturing output increased by 0.4% in April, a modest amount, held back by a 4.3% drop in motor vehicle production affected by the global shortage of semiconductors. Why is my price of used cars going so high? Well, there you go, man. But the semiconductors on used cars, the semiconductors don't affect used cars. It's called substitute effect, man. Substitute effect. If there's a increasing demand in new cars and there's a limited supply because of semiconductors going to the lot of cars, then people are going to say, okay, I'll buy this car instead. Substitution effect, man. Semiconductors finally arriving. There you go, man. The most recent U.S. trade report revealed that imports of semiconductors jumped to a record high last month, and the pace appears likely to continue. All right. Based on Taiwan, the country of Taiwan's export data, I said it, John Cena, Taiwan, and I'm not going to say in Mandarin to apologize to my Chinese overlords of the CCP. What was John? What is that? What is this groveling? Crazy. This suggests that one of the major supply bottlenecks, the semiconductor shortage, may become less acute in the coming months. Of course, shortages are much broader than just semiconductors, but this is an early sign that the first supply shortages may be starting to ease. Housing was one of the first industries to boom after the onset of the pandemic. Rising prices of lumber, which translated to rising home prices. I just did a video yesterday where I showed you that the average cost because of price in lumber of a new home is increased $36,000. By May of this year, the price of lumber had soared 400% from its low in 2020. Oof. Housing data released in May showed soaring demand has pushed up home prices in the U.S., Canada, and New Zealand. That rise has now met some resistance, exactly. Much of the rise in lumber prices in April and May is likely due to home builders scrambling to meet obligations on the rush of contracts signed in the first quarter. Yeah. Lumber prices have started to react by easing of demand. That's just a good old-fashioned price mechanism, man. So we see lumber future prices, corn future prices, iron. You can see right here, here's lumber. It's got to bounce up off his bottom. So is that a dead cat bounce? We'll see. I don't know. That's just for 6 months, by the way. All right. Inflation is likely to continue to rise and remain above the average of the last global economic cycle, but essentially rapid pace of current rise may soon start to moderate. Inflation expectations only back to where ECB last cut, not hiked interest rates. All right, so right there is last cut. Inflation expectations. I'm not sure what this is. What's this right side? I'm not sure. I don't know which one is which. I guess this is the ECB rate right here, and here's the inflation expectation. So it's gone up for sure, but it's 1.5. Since markets tend to react to the change of the change, a coming shift to a slower pace of increasing prices can be important for both inflation-sensitive assets and central bank actions. There are some signs that sharp rise in prices may be curbing the short-term surge in demand for commodities, capping momentum. While inflation is likely to be higher in the years ahead compared to the past global economic cycle from 2009 to 2019, if these early signs continue to signal a deceleration of the upsurge in price pressures, market worries could begin to lessen. All right, no comments there. So I'll put a link in the show notes. But I am going to share this other article that kind of this is interesting here. Inflation, money supply, and money and supply bottlenecks, and it'll be interesting. I'll share this with you here in just a second. So hang tight. Thanks, Dan.